The question I get asked more than almost anything is, how do you know what to watch? And how do you build your plan as a financial advisor? Because with markets, recessions, volatility, and headlines, most people feel like they're standing outside of it, just reacting to whatever information comes across their screen. But inside finance, the process looks very different. It's less about reacting to reports and more about observing behavior, less about waiting for confirmation and more about recognizing patterns before they're printed. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist, and I own Diamond Point Financial. With Pointe Perspective this week, we're pulling back the curtain. I'm breaking down how markets and the economy intersect, and more importantly, how we think about it analytically so your financial plan can begin shifting from reaction to strategy. In today's discussion, I'm going to walk you through that mindset. First, we'll talk about the rise of individual investors and how emotional participation can amplify volatility. Second, I'll show you what I actually pay attention to, from industry conversations to CPI, jobs data, and consumer sentiment, and I'll discuss how those signals fit together. And third, we'll connect it all back to economic cycles and behavioral positioning, when to be cautious, when to be bold, and how contrarian discipline often creates opportunity. Because financial success isn't about thinking perfectly, it's often about thinking differently. Over the last decade, the growth of individual investors in the market has been dramatic. With zero commission trading, social media investing communities, and we've seen options trading becoming more mainstream. That participation alone isn't inherently bad because I love the idea of more people getting into the markets, but that also means that lack of objectivity and emotional participation has created some instability. We can't rely solely on historical data anymore because the environment continues to evolve. When large groups of retail investors react simultaneously, whether it's fear, hype, or trending narratives, we've seen it amplify volatility, and that's not always in a healthy way. Yes, some do get lucky, but far more of what I've seen are people buying after the move has already happened and selling after the damage is done. There's a reason why experienced, seasoned investors say to buy the rumor and sell the news, because by the time the headline or your Facebook group confirms something, markets have already priced it in. So what are some things that you can observe in order to identify opportunity the way a professional does? First, gathering data cannot be dependent on printed information. If I'm trying to understand what's happening in the auto industry or discretionary spending like boats and RVs, I'm not waiting for earnings season. I'm talking to people in those industries about the trends that they are seeing. Dealership managers or owners, salespeople, manufacturers, real estate agents, and lenders, they feel demand change before the reports print it. Same with employment. Before I read the jobs report, I'll talk to people in HR or staffing agencies or recruiters because they are going to see hiring freezes and a shift in wages before the payroll data confirms it. Reports are backward looking, but behavior is happening in real time. Now, I do still watch the data, but much more as confirmation, not discovery, because once it's printed, it has likely already happened. The Consumer Price Index report and jobs reports are two reports that we continue to keep our eyes on. The CPI report is released monthly by the Bureau of Labor Statistics. It measures the average change over time in prices of goods and services paid by consumers. It is the primary indicator of inflation in the US, and it tells us how fast purchasing power is eroding or stabilizing. Now, the monthly jobs report, or the official term is the Employment Situation Summary, is also released by the Bureau of Labor Statistics on the first Friday of every month. It gives more insight into payroll growth, employment rate, and wage growth. But both of these reports describe what has already happened, and markets often react before the public has even fully processed them. One of the few forward-looking indicators we have is consumer sentiment. And if you're a client, you've heard me say that this is something I pay close attention to. Consumer sentiment measures how optimistic or pessimistic households feel about their financial future. When confidence is high, we see spending increase, borrowing increase, and risk tolerance will rise with it. But when confidence falls, wallets close, big purchases get delayed, and savings rates start to rise. Then we start to see those emotional shifts typically show up in economic data 1 or 2 quarters later. Looking at consumer sentiment trends since 2019. In 2019, sentiment was relatively strong. It was consistent with late cycle expansion. We all know what happened in 2020. We saw historic collapse during pandemic uncertainty. And then in 2021, there was a sharp rebound as stimulus payments went out and reopening started to surge. But in 2022, we saw a major drop after the invasion of Ukraine. Then, along with the inflation spike and the interest rate hikes, sentiment hit some of the lowest readings on record. As we moved into 2023 and 2024, there was a gradual stabilization, but it remained below long-term historical averages. Looking at this data, we start connecting these events to historical trends we've seen and studied. Sentiment tends to weaken late in expansion cycles and then recover early in contraction phases, which confirms what we've been discussing this whole time, that behavior often shifts before GDP. This is where behavioral economics intersects with cycles and ultimately your financial plan. In early expansion, we see confidence rise. People are eager to invest and their appetite for risk expands. Late in expansion, excess builds, confidence peaks, and that's when you start thinking about saving more, reducing your risk, and holding liquidity. As we move into contraction, fear starts to dominate. Asset prices reset or rebalance, but you start to see opportunities begin forming quietly. Does this timing maybe sound familiar? Then you enter the trough. Others pull back completely, but that's when positioning matters most. You have to be brave when others are frightened and cautious when others are bold. That's contrarian behavior. It's not natural for humans to want to take on risk when everyone around them is scared, but if you can hone that skill, even when it's uncomfortable, it could be rewarding. Here's a real-world example for you, and it's not even related to investing in the market. You and your spouse have been wanting to buy a car, but over the last 2 years, prices have hit peaks and demand has stayed high. Because of that, your negotiating leverage was minimal. Now we start hitting that contracting period, and you look around. Demand has cooled, inventory has built up, and you know what we discussed about supply and demand a few weeks ago? So now dealers are more flexible and your money can go further. That's behavioral timing based on cycle awareness. And most importantly, that's your patience paying off. This same logic applies to almost everything. Large purchases, travel, even daily retail. As much as I like to watch the printed data, I also watch trending human behavior. When underconsumption cores started trending on social media in 2024, that wasn't random. That was a cultural shift and an indicator of the peak phase in action in real time. People were reassessing their spending, reevaluating debt, and prioritizing minimalism. Social media behavior reflects economic psychology, and I would never make the mistake of underestimating the power of influence. Before we move on, I want to impress on you the number one thing I do not watch, and that is political headlines. As election cycles heat up and recent geopolitical tensions increase, the noise around them will get louder. Please remember that individual political opinions do not determine market outcomes. Policy matters, structure matters, and regulation matters. But emotional attachment to a political identity can cloud your judgment. I approach the political landscape with one assumption. We want to succeed regardless of who is in office. That objectivity allows for flexibility, and flexibility allows for survival. As we move into March, we're shifting our strategic planning focus toward protection. Insurance isn't about being afraid of what could come your way. Like everything else we've discussed, it's about creating a structure that's ready for it. This month, we'll discuss life insurance. What is term, what is permanent, and who does it usually work for? How often should you review your current situation with a survivor needs analysis, and why preparation matters before making these important decisions? We'll also talk a little bit about disability insurance along with long-term care insurance. We'll discuss when it works, who it may be appropriate for, and how to evaluate your own situation. And later this month, we'll review more advanced structures like annuities, which are insurance contracts that can include investment components. But that discussion requires more attention and we'll handle it separately. As you build out your financial plan, you're going to want to preserve it along the way, or else what was all of this hard work for? Today, you stepped inside the analytical process. You saw how behavior drives markets before the reports confirm it, how sentiment often shifts before GDP does, and how disciplined positioning within economic cycles can create opportunity. This is what professional thinking looks like. It's not about Facebook groups or Reddit threads, and it's certainly not about keeping up with every single headline or news-driven trauma cycle. It's about maintaining an objective perspective so you can move through your financial plan strategically with confidence. If this perspective was helpful, subscribe to the channel for more discussions like this, and make sure you sign up for our weekly newsletter using the link below. Until next week, take care.